Mortgage 101, your guide to home ownership. We have new listeners all the time. And as a matter of fact, I receive emails from people who say that they really enjoy the show. But for those who don't know who you are, Clinton, why don't you let everybody know a bit about what you're all about?
My name's Clinton Wilkins. I'm a mortgage broker here in Halifax. I've been doing this for 17 years, and over that period of time, we've done over 5,000 transactions and, almost $1.4 billion worth of mortgages. Every day, I say I've seen it all, but every day I see something new. So mortgage lending, I think, is super exciting. Honestly, it's one of these times that it's really in the news, and I'm glad that we're here, part of the conversation on City News or wherever you listen to your podcast. I think we have a lot of really great listeners as well.
I thought you were going to say 5,000 shows.
5,000 shows? Well, when we get to 5,000 shows, we'll have a party. Don't worry. We'll invite everyone.
Exactly. All right. So, yeah, we do talk about, obviously, mortgage lending, but there's so much to discuss, and now interest rates is front and center. Everybody's talking about interest rates, with the Bank of Canada setting the interest rate at 5%, this last increase. So obviously somebody's lending rate would be what, 6.5? What would it generally be now?
So just to give a little background, the Bank of Canada met last week on Wednesday, and they set the key overnight rate at 5%.
Right.
The bank prime rate is now 7.2%.
7.2, yeah.
And if you have a variable rate mortgage or any unsecured debt or any, debt that's connected to variable, Bank of Canada prime in terms of the bank prime, your payments have gone up, or your amortization's gotten longer. So certainly it has had a major impact.
Major. Yeah.
And, we're really talking to customers every day about what does that impact look like. And, we have a lot of clients that are in a variable. Historically, there's a certain percentage, like 40% of customers are in a variable rate. So certainly Canadians are starting to feel the pinch. And I know I talked to you about Equifax and TransUnion had put out some writing that consumers are starting to miss some of their loan payments. It's because it's not just mortgage interest that people are really feeling the burn about. We were talking about this before our show. It's about fuel cost and food cost. That's really driving up some of these inflation numbers. But the good news is this week, the Bank of Canada came out with a release saying that inflation was down to about 2.8%.
Yep.
Still a very high driver, the cost of housing, and obviously the cost of food. And I mean, these are impacting everybody, right? It doesn't matter if you own a home or if you rent. Everybody's starting to feel the burn here. And when the Bank of Canada increases these key overnight rates, it impacts businesses' access to credit, their cost of credit, consumers. Everyone is starting to be impacted. And what the government's trying to do is really slow the economy and bring that down to, a recession is what they're looking for.
All right, so you're talking 7 point what again is the interest rate?
7.2 is the bank prime rate for the majority of bank lenders.
So if somebody's at a variable, what would they be at? Around that 7.2? Or
well, I would say normally lenders are usually below the prime rate. Right. So anywhere from 100 basis points below to 50 basis points below to 30 basis points below. The variable rate you're looking at is somewhere coming up on 7%. It's between 6 and 7%.
Right.
And that's where you're at if you're in a variable rate in terms of a mortgage.
Okay, so a year ago, when somebody would have, even or perhaps a bit before that,
even if we talk 2 years ago, before even the increases started,
a variable was at what?
Like 1.45, 2%.
Exactly. Right. So if somebody, let's say, has a $500,000 mortgage, okay, what does that look like when it comes to their payment? How much of an increase are we talking here?
So now, obviously, the interest rates have gone up significantly.
Yes.
So maybe their interest rate has gone up 3x, but their payment has not doubled. And people don't really understand that piece. I think what they don't understand is with the interest rates going up so much, they just assume, okay, if the interest rate doubles, my payment doubles.
Right.
But that's not what happens, because every payment is made up of an interest component and a principal component.
Yes.
Obviously, the interest piece has certainly gone up.
Right, but the payment piece has not.
Not the principal portion of the payment.
Right, yeah.
So I hear from customers where their payment has gone up 50%, for example. It hasn't doubled, but it's gone up by 50%. And you know what? That's significant.
Yeah.
And it's certainly having an impact. And some customers are choosing to refinance their mortgage or maybe renew it early or convert it into a fixed rate. But not every solution is right for everyone. Like I have people email me, well, what should I do? Everybody's situation is different. I think it's really important to look at Is the payment still within your reach?
Mm-hmm.
What's your level of risk tolerance? What do you think is going to happen with rates over the next 1 to 2 years? What's happening with your life in the next couple of years?
Yeah.
Because some people take the variable because it was cheaper.
Mm-hmm.
Some people took the variable because they want to have the flexibility to be able to break their mortgage early and know it's only going to cost them 3 months of interest.
Right.
Other people, are somewhere in between. And, if you're planning on keeping your house and not planning on making any changes, maybe a fixed rate is right for some people,
mm-hmm.
but it's not right for everybody. I think you need to really know when you enter into a fixed rate mortgage, it is a commitment.
Mm-hmm.
And the banks are like the casinos. They don't lose. And typically, if you break a fixed rate mortgage early, you're going to pay either 3 months interest, like you would if you break a variable rate, or you're going to pay an interest rate differential. And it's whatever is larger. And the banks really don't know even what the interest rate differential will be down the road, because it's really what you're borrowing that mortgage at and what the rates are at that time if you were to break it, and how much time is left on your term. So lots of factors that obviously impact what the penalty will be. But historically, Canadians break their mortgage early, a large percentage.
Mm-hmm.
So I think that's something to think about when you take a fixed rate mortgage.
All right. So if somebody has a variable mortgage and they go fixed rate,
Mm-hmm.
should they look at potentially a 3-year fixed or 5-year fixed?
I would say the most popular right now is a 3-year, but historically a 5-year fix is the most popular. 60% of Canadians will take that type of product.
But right now, we're
not in a normal time.
Well, and we're looking at perhaps we're at the crest here of this interest rate, or we're nearing that crest.
I would say.
So in the next 3, certainly 5 years, that's going to come down. So if you get stuck in a fixed right now, then
you may be really in it for the long run.
For the long run at 7 point whatever. Whereas
Correct.
with the variable, in 2 years, you could be looking at 3 or 4%.
Now, don't get me wrong. Every rate today is starting with a 5 or a 6. I would say pretty much. And sometimes clients are coming up for renewal and they're like, you know what, my rate was 4%. I just want to keep my 4% rate. Well, that rate doesn't exist anymore. Once your term is up, your term is up, and that rate then needs to, obviously be renegotiated at that time.
Yeah, but am I making sense though? If somebody goes with a 5-year fixed,
it is a commitment. It is a commitment,
and probably rates are going to go down over the next 5 years.
I would assume in the next 1 to 2 years we're going to see rates go down, especially if we start going into a recession type situation.
Exactly. So a 3-year fixed, or even perhaps could you do a 1-year fixed?
You could certainly do a 1 year, but the banks aren't stupid.
Right.
The 1-year fixed are very, very expensive. You're paying about anywhere from 6.5% up to like 7.5% for a 1-year fixed. So it just depends on which lender you're going to go to.
Yeah. So I would think, and we're almost out of time on this segment, but perhaps we can talk about the stress test and how that's now changed.
Huge impact. Right? Obviously, as the rates are higher, that stress test is even harder to qualify. So certainly something to talk about later in the show.
Yeah, we can talk about the stress test. Also in the show today, we're going to talk about pride and home ownership.
That's right. Pride is here. And, it's been a tumultuous time, I think, for pride in Halifax as well. So we'll touch on that.
Yep. And perhaps a few other things, and some more music choices. Hopefully you can match my incredible opener.
All right, well, we'll wait for the next segment, and we'll see which song's going to be up next.
All right, it's Mortgage 101, your guide to home ownership, with myself, Todd Veinotte, and Clinton Wilkins, and we will be right back.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.